Hello and welcome back to the complete day trading course by Wealthy Education. This is how to trade head and shoulders. So I'll go ahead and define a head and shoulders pattern first. And it's simply markets moving like this or the inverted head and shoulders like this. Well, think about what happens. You're in an uptrend, for example, and you rally and you make a peak and you pull back. And you make another peak, the second peak, which is the head, those are your shoulders, and you pull back again, but the third peak loses a bit of momentum. Well, that's the first sign of trouble. Head and shoulders patterns are very common, they're very widely followed, and a lot of traders will pay attention to them. Why I like them so much. This is a downtrend, an inverted head and shoulders. You see we go a little lower, we pull back like you would expect, we go even lower. That's even better for the sellers. But then the third time, we don't continue the downward pressure. So what invariably happens is that a little time goes by and those traders start to become a bit concerned, and there's a neckline there. And the reason the neckline is important is because it's the trigger for selling, because you're in an uptrend, you've got people who bought all the way up to here, all the way up to here, even to here. But once you get through this neckline, you're breaking lows on a lot of different groups of traders. You have trapped traders, if you will, and then you sell off. The head and shoulders has a built-in measuring stick. You just take the highest point of the pattern to the neckline and then extrapolate that down. Pretty straightforward. It just is a failure to continue to make an uptrend. They don't have to be straight up and down. They can be at angles as well. Instead of just straight. The ones that are straight like this are a little easier to spot though. But beyond that, there's really no difference. So I'll go ahead and mark out the head and shoulders on this chart. Mark out the neckline. So by the time you break down through here, you have all of these traders are trapped. What you do is you measure the height, like I had said earlier, and I'm going to eyeball this and say that we are looking at a bottom of 133, a top of 134 and 10 cents or so. So that's about $1.10. So on this breakdown, you're looking for a move about $1.10 lower, which would have been 132. You most certainly got that. There's also the inverted head and shoulders. So you can see as a recap, we rallied again, we got a little exhausted and broke apart. The inverted head and shoulders, and this one we've been moving lower on Intel, the 15-minute chart. You can see everybody's happy. Then all of a sudden, there's a bit of a problem. You can see that, let's see, 50 and 49, maybe 48.90. So that's $1.10 or so over here as well. Once you break above there, we do drop back down, but we eventually hit the targets. Now, the question is, where do you put stop losses? Well, the most obvious place to put a stop loss is behind the shoulder. And that's what most people will do, because by its very construction, it's going to be less than you're aiming for, because you're aiming for that distance and this distance is lower. So although you would have had a bit of a scare here, your stop stayed in place and you continued to go higher, eventually collecting your profits.